ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
Hello, welcome back to Traders of the World. I'm your host, Flavio Lemos. Today, we are exploring the journey of navigating global markets, building a disciplined process, and the vital importance of finding your community in the often solitary world of investing. Just a quick note before we dive in, our guests generously share their valuable time and experience. If you appreciate their insights today, hitting the like button, subscribe, and commenting with what you learned is a wonderful way to show that gratitude and helps ensure these important conversations reach fellow traders and investors around the world. For such a special occasion, I'm not alone. I'm thrilled to be joined today by co-host Alan Soares. Our guest today is Dominic Dantas. He's the founder of the investment advisory firm Dantas Outlook, specializing in global portfolios, asset allocation, and ETFs. He holds the prestigious CMT designation and serves on the board of directors for the CMT Association. Dominic is also a passionate advocate for inclusivity as a founding member of the CMT Global Black Caucus, a regular contributor to major financial media, and a mentor to the next generation of analysts. His approach is a fascinating blend of global macro, quantitative analysis, and the technical methods we often discuss on the show. So, we know the longest, Dominic Dantas, is a real pleasure to have you with us. Welcome to Traders of the World.
Thank you so much, Flavio. It's a pleasure to be here.
Dominic, it's a real pleasure to have you with us. Welcome to Traders of the World. You were passionate about markets from age 12, trading through the dot-com era, 9/11, and GFC. What was your key lesson?
Thank you. That's a good introduction. It did start very early on for me. I was about 12 years old in middle school, junior high school here, and my dad was always into business. He studied that. And, I learned from him a lot in terms of understanding not just business and how it operates, but the market, right? My family was entrepreneurs. And I became fascinated just by looking at CNBC and all of the financial media, by just understanding what was going on. This was during the 90s, the dot-com days. So a lot of familiar names that were being listed were actively traded. So, my way of organizing that is just to be an active participant in the market, of jotting down price quotes, right? Seeing what was the highest and the lowest. And I had a little stock market notebook, and I used to go around the lunch table in school and talk about it. And that's how I found friends, right? I was doing something unique and something interesting. So I found my tribe that way. And I think the most important lesson for me during that time was markets are resilient. You have to have a particular strategy, and maybe thinking long term is very interesting. At that point, I think for most people's introduction to the market is very short term, because it's fantastic. It's a lot of activity, but I think over time you learn the hard way that long term is definitely a better way to preserve your capital and grow. So, as you mentioned, those events that were shocking were like 9/11, and we had a series of bankruptcies around the peak of the dot-com bubble, like Enron and WorldCom. So you learn about accounting scandals and how you need to be a better judge of company performance at a very young age. And I remember the Fed and how they were responding to that crisis and all of that. So it taught me to think macro, but also know that markets are resilient. So that I gained a lot of good appreciation for.
Like Rocky Balboa, huh? Very resilient.
Very resilient, exactly. It can take the punches, but if you're able to navigate it and have a good process, it can be very rewarding.
Okay. Your process uniquely blends global macro, quantitative, and technical methods. Can you walk us through how these three pillars work together? How do you weight them? And how does the technical piece inform or confirm the macro and the quantity views.
Mhm.
If you
So
wanna, we can show some one of your slides here too.
Sure. Yep. So
Okay.
we use a three-pronged approach, and this has been through years of adapting the strategy. And you know, when I first got my CMT, the core discipline of price was very interesting to me. So everything revolves around price, and price to me is a function that can either be up and to the right or down and to the right. And what signifies that trend is persistent buying or persistent sellers, and that creates a long-term series of price direction. Now, you know, positioning with the trend sometimes can be, you know, not as timely. So one way to measure the speed of that price change, right? Think about derivatives, are momentum. And momentum is just looking at the strength of that trend. And when momentum is accelerating, it shows renewed upside. And when it's decelerating, it's a persistent downward pressure in regards to the prevailing trend. And then a way to measure when the trend has exhausted itself, perhaps, and that could be looking at dispersion. So you have areas where you can standardize it within a zone of maybe 0 to 100, or you've seen very different oscillators. And that just measures the space or how far that trend has accelerated or decelerated from its long-term average. That gives us a sense of when to lighten up positions or look for emerging opportunities. A good layer on top of all of this is not just looking at the absolute price changes, but how they work relative to other asset classes, or in our sense, relative to a benchmark. So that gains us some advantage in terms of timing our entry and exit points, but also positioning really well within the context of the trend. So when you ask about weighting, we don't really necessarily weight them too much. What we do is we look at them in the context of the trend. So the trend is always supreme, especially in portfolios. If we have a strong uptrend, that is definitely a core position, especially in relative terms. But when you're looking at maybe trading or maybe a shorter term time horizon, momentum tends to be the strongest indicator for us. So if you have an area of extreme dispersion and you have momentum on top of that, that is a good indicator of a particular entry point. And then if you have an existing trend, let's say it's in an uptrend, and then you have momentum signals that's confirming a buy, that could be very interesting because it sort of confirms a long position. So we look at it as confirmation.
Okay, your adaptive trending models describe a sophisticated trading work combine trend plus momentum, dispersion, momentum confirmation, and relative strength. How do these layers interact adaptively? How do you weight trend following signals against mean reversal signals, for instance, when deciding between maintaining a core position versus making a tactical tilt?
Yep. So just understanding the market environment from the get-go. If we are in a trending environment, definitely the trend and momentum signals matter more than your dispersion signals. If you're in a range-bound market, obviously the dispersion signals might be more heavily weighted than say a trend signal. But I always like momentum and dispersion because momentum is the common ground, right? You can have momentum with the trend, and that's great. You can have momentum with dispersion, even better. But trend and dispersion don't work well together. Right. So you need to understand the current market condition and then apply your indicators on top of that. And what we learned is not just one indicator that tells you whether or not to buy or sell. It's a combination of the indicators that gives you a system to work out of and how they interact. So, you know, some indicators involve volatility, and that could be a good adaptive approach. Some indicators like a MACD and a Bollinger Band, for example, can signify an area of momentum within dispersion, right? So that is one area where you can combine two disciplines. So we worked on that to develop our models, and that's kind of how we position. Now, from the portfolio side, as I said earlier, the core should always be in the position of a long-term prevailing trend. And then momentum and dispersion allows us to tilt or take profits away from that core to then reallocate into emerging areas. And relative strength is the way that we manage opportunity costs. For example, you might have an existing strong position in the US stock market, S&P 500. That was our long-standing overweight over the past couple of years. And obviously this year, you saw more globally diversified assets become more favorable. So what we did was we just narrowed our extreme overweight and then went into areas of relative strength because we had the capacity to do so. Rather than being reactive, we're more adaptive to market conditions.
Okay, building on that model, you make opportunities tilts using relative strength. How do you then manage conviction?
Hmm.
Can you explain how you use momentum analysis to spot renewed strength, test its durability, and confirm relative strength to enhance active performance?
Mhm. I would say conviction is tough because we have a benchmark, right? So we don't want to stray too far away from it. We have certain mandates for some portfolios. So I would say the conviction there is, there's certain positions where we have outsides, like our tracking error is larger. And that's because we have conviction of either a trend that has momentum and dispersion, all those three elements signaling positive. That is very rare. So when we do find that opportunity, especially in relative strength terms, we do up the weighting accordingly in the portfolio. Now, our absolute strategy models and models that don't follow a benchmark, they're more unconstrained. We keep it equal weighted, right, just to maintain our balance in a way. So we don't like to take too much extreme risk if we're not compensated for it. We like to just choose the assets that are leading in any case. And then if, until they show an area of underperformance or some weakness in one of our signals. So we're easily able to get in and get out. And we're looking for the leaders and just avoiding the laggards. I think if you avoid the laggards at general case, you can withstand some buying power in the market, right? So we're not in the business of predicting or creating outlandish calls. We're just in the business of maintaining with the trend and avoiding significant drawdowns.
For instance, on this chart you have here, you
Mhm.
would buy or sell which one of the assets?
So this
Using
chart, I'm
this as
trying
an
to,
example.
So this is looking at equities, right? So in the opportunity zone is where we see strong momentum above zero, and then it's still below its average on the Z-score, below zero. So that's, I would say, Hang Seng, right? So the area there is more of the offshore Chinese markets, right? More so than the onshore over time. So we have been positioned there. We have an emerging market tilt outside of the US equity core. And that emerging market tilt from the benchmark's positioning is heavily weighted towards Chinese equities, of course. So that's kind of where our core position within the tilt lies. Now, those other areas, if you see the yellow dot below, I believe that's the Saudi Arabia market. Now, this has to be updated because Saudi Arabia has shifted a little bit, but that has been showing some emerging opportunities within the EM asset class. So if we were able to take a country-specific approach, that's kind of where it would come from. On the right-hand side are areas that we would potentially avoid if it's on the right-hand side and below zero. So that's signifying weak momentum and also it's stretched relative to its average. Those are areas we don't want to avoid. And there's nothing really there because equities have been very strong. Now, to the upside, those are areas that were existing core positions, but we're not moving the needle too much because it has strong momentum. It is stretched above its average, but we have no signifying evidence of it shifting. So those are core positions like US equities where you don't have to do too much because the momentum is there to compensate you for that additional risk that you're taking. Now, it is only when it's extended so much to the upper right-hand corner and we find it drifting lower and lower, we can take cash from those positions and rotate into those positions that are more favorable, value, and increasing momentum over time. So that's how we dynamically adjust the portfolio in a clockwise fashion.
Okay. We emphasize managing risk versus reward using tools like ATR, average to hand, and Z-score analysis. Could you elaborate on how these specific tools help you identify potential volatility shifts or stretch trends? On how do these signals translate into actionable portfolio decisions?
Yeah, so this came through many years of iterations because some asset classes are more volatile than others, and some models work for some asset classes and some models don't for others. We're in a wide area to play with, right? You have equities, fixed income, commodities, and currencies. That's our main focus. So equities, they trend really well, especially developed markets. So we definitely.
Olá, espero que esteja gostando da entrevista. A Trader Brasil foi eleita por 2 vezes do Rank Awards 2024 e 2025 como a melhor academia de formação de investidores do Brasil. E ela tem um presente para você que está assistindo esse podcast. 10% de desconto, é só usar esse QR Code que está aqui embaixo e a gente te espera lá. ok? Agora não esquece de dar uma moral pro Flávio. Curte, compartilhe esse vídeo e se inscreva no nosso canal, ok? Até a próxima e obrigado pela presença. Valeu!
Weight more on the trending indicators and momentum there. Now, as you go further and further out of the US into, say, emerging markets, they become more erratic and non-trending, some markets. So that's where we considered an average true range to be a little bit more adaptive to the volatility that's respective of that market, especially when you go into currencies. Currencies can be very volatile and choppy and not necessarily long-term plays. So we don't take direct currency positions, but we look at currencies in the context of our portfolio. So when we want to increase dollar sensitivity or decrease dollar sensitivity is basically a call of going abroad or domestic from the US standpoint. So we look at that in terms of using its ATR to judge where the dollar is, right? Now, if you look at commodities, for example, very momentum driven. Some tend to trend really well, like gold and some other metals, whereas others, like energy, are more range bound over the long period of time. So that's where you would want to use an ATR or some sort of dispersion model more so than a trend and momentum. It is very complex as you add more asset classes to your universe. But the common point is that your model or whatever you're using has to adapt to that asset class's characteristics that are very unique. And that's true for anybody trading or managing a portfolio. Understand the asset that you're working with, its unique form, and adapt your process to that. Sometimes your process is not going to work on one instrument and another it may work stellar. So you've got to be a little bit more robust and tactical.
Okay, your firm focus on global portfolios and ETF construction. Apply your blended process to the world today. Where are you seeing opportunities across different countries or asset classes? And what role do ETFs play in implementing those strategies?
So ETFs play an important role for us. It's an efficient wrapper. It allows us to diversify our exposure without taking concentrated risks. So the ETFs that we pick, we have some active ETFs here and there, but they're mostly passive instruments. And that allows us not to concentrate too much. Where we're seeing the opportunities right now in our portfolio, obviously we have reduced some of our tracking error relative to the benchmark heading into October, which is seasonally volatile. So that makes sense. We have not been taking too much active risk there. We maintain a US core overweight exposure that has been balanced to emerging markets and just international in general over the past few months. But we saw that diversification element narrow over the summer months. So we repositioned back into the US. That has been very beneficial. We maintain a tactical weight to emerging markets because the opportunities are there with strong momentum and not yet stretched relative to its average. So that's been a sweet spot. Equities have been the main driver of our global 60 moderate portfolio. Outside of equities, we have a commodity sleeve, and that commodity sleeve has helped us maintain an inflation hedge or some sort of cyclical advantage. If you think about late cycle positioning, it tends to be more heavily weighted towards equities and cyclicals within equities. So areas like gold have been a very good benefit for us there, as well as the broader cyclicals. So balancing energy and materials overall. Within fixed income, we maintain an underweight there because it's not showing any momentum relative to equities. But within fixed income, we get a lot of active return. So looking at the intermediate term treasuries has been very beneficial to us. Lately, we've been seeing some signals to, perhaps drift further out of the curve into longer duration. So that could be interesting from the fixed income side. And then some models have a particular aggressive component. So the moderate is a global 60-40, but on top of that, clients can allocate towards a crypto rotation. We've scoured around to find areas where we can get the most juice out of equity-like returns, and it actually came from crypto. But what we saw is that managing the volatility or the downside in crypto is prudent, right? You have to do that. So what we did was look for an asset class that had high correlation to equities, that was Bitcoin, and then an asset class that had low stable correlation to equities, which was gold. Now, obviously, those correlations shift over time, but generally having one versus the other can help you identify areas of risk on versus risk off. And when it's risk on, it could be the added juicer to your moderate portfolio. And when it's risk off, it could actually produce some good stable returns when moderate is a bit too moderate. So for an aggressive client, that works really well. So what we did here as an example is look at Bitcoin versus gold and its shifting correlations over a 90-day rolling period. And what we saw was in Q4 of last year, gold was actually picking up relative strength to Bitcoin, the same to equities as well. So we shifted into early this year with a heavier weighting to gold and a lower weighting to Bitcoin. And that produced some really good returns rather than just investing in the crypto itself and not being paid for that extra volatility. We always like to get paid for the extra volatility. Yeah. So, and then on the right-hand side, you can see the rotation from gold into equities and gold into Bitcoin. So gold is inducing really good returns for the most part of this year relative to our traditional asset classes.
Given current global markets, where are the opportunities for global portfolios and ETF construction using your branded process? What role do ETFs play? Has the UAE escaped the oil curse?
Yeah, intermarket analysis is so big. You know, I came from Fidelity, and those days we were on the global asset allocation team. So you're always looking at what the oil market is telling you about the economy, or looking at the market in general as a signal, as an economic signal, because it is a leading economic indicator. So that to me was already ingrained in my discipline. And coming here and putting it into practice, definitely we look at intermarket relationships on a relative basis. So, you know, even though we have a commodity sleeve, that commodity sleeve only gets allocated if it shows strength relative to, say, the fixed income sleeve or the equity sleeve. And that's exactly why we rotated into gold so early on, because it was showing relative strength in an area that was already very much stretched relative to the core commodity. So it is all a capital discipline approach, and you only get that by looking at intermarket analysis. You tend to think about it as the markets are fighting for your capital, and they have to fight each other to get the winning prize, which is your allocation. So that's how we measure things. That's how we see things. We sit up top and we just look at the market and scour around for opportunities on a relative basis. Now, in terms of what we're seeing now in terms of relative or looking at intermarket, you know, the gold to equities, it looks a little bit stretched now tactically. So we have been trimming our gold over the past couple of months, and obviously now you have the outsized move. So, you know, that makes sense for us to kind of come back. We only have a small weighting in gold in the portfolio. It produces some edge here and there, but I think that's manageable. Equities versus fixed income still very high, but that is getting a little bit too extended, and we might be rotating somewhat into the fixed income bucket, maybe into longer duration treasuries, perhaps. So those are areas where we look at in terms of, you know, moving our capital. Now, Dubai was so fascinating. It was great to be in that region and really just understand their market. And it is very oil dependent, the market itself, even though they've been moving away from oil. So we looked at the correlation of the TASI, or the Tadiwal All Share Index, to Brent oil. And right now it is very high, but it has these areas of boom bust. So when the correlation is kind of low or lower than normal, you tend to find these areas of opportunities that might come about from a sector perspective within the Saudi market. So what we found is that when the Saudi market is sort of bottoming or consolidating, you tend to have banks lead and then materials lead. These are sort of the inputs who are recognizing the picks and shovels of oil. And then you have oil advance alongside the TASI index. So that's very interesting by looking at the relative strength of their sectors versus the broader index in Saudi. And Saudi has been very depressed relative to the EM asset class, relative to the global equity market too. So there's been a lot of interest, I think, coming abroad into that market. And what it's doing is actually pulling some of the allocation within the GCC region, so like Kuwait and Bahrain, into the Saudi market, where PMs there have to rebalance their portfolio by realizing these value opportunities that have now seen momentum, just like we're doing. So it was very fascinating just to learn about that market and see how our framework is easily adaptable to a market with price data. Now that price data is very still, you know, early and choppy, but, you know, once you navigate it, you can really do some great work. So I was very fascinated to be there with the CMT Association, not only in Riyadh, but in Dubai. And it was a fantastic, we missed you, Flavio. So it was a fantastic event.
Yeah, I know that. Next,
Yeah.
next I will be there. So changing gears. What's the core mindset shift you emphasize to help people make better decisions, whether professional traders or individual investors?
Follow a process and be disciplined. I see a lot of people, either early on in their investment journey, and I myself was the same way, chasing for opportunities. And I've learned over time that it's best when opportunities come to you, following the filter that you've put in place. And some market conditions are not prone for your participation, maybe because you're not good at it, right? So I learned early on, I'm not good at trading volatile markets, so I'm not good at positioning portfolios around volatility because it is very choppy and I don't get much of a signal. And you have to be humble enough to know when to step back and find the opportunities that are more consistent with your style. And that allows you to double down on what works well. So I've learned that discipline over time. It is not easy, right? Sometimes we do make mistakes, but I also say, there's always an opportunity to go back to your process. Sometimes the market doesn't give you an opportunity, but you always have the chance to sharpen your process. So that's what I would say there. And consistently learn. The market is the best teacher, and there's so many other people who are brilliant and doing things that for the good of the investor. So I think it's your duty to continue to learn more, especially if you're managing money for others. So definitely take the process and expand your knowledge, expand your education. And lastly, think globally. Here in the US, we are very domestic focused, and I grew up with a lot of that too, but I always had an international mindset. And I think that allows you just to be opportunistic in general. So I have friends from all around the world. I have markets from all around the world. And it is very fascinating just to understand all of the dynamics of the global economy, and knowing that I can too be an investor in that global economy, to me is very rewarding.
You wrote about learning we can control what we put in our notebooks and who we surround ourselves with. What should one aspiring trader focus on controlling in their own process, especially when markets feel chaotic?
Yeah, so the notebook I was referring to is my stock market notebook, and after 9/11 and the Enron scandals, all those companies, I mean, as tried as it may sound, but like United Airlines and these stocks that were hit during that time of 9/11 were in our notebook. Enron was in our notebook, because we were blindsided, right? And nobody could predict these things, right? But just knowing, and obviously the .com names that went bust, there were names that we had to scratch out because they were delisted or went bankrupt. So we went through these cycles of extreme swings, and just knowing what you put in your notebook is important, right? So knowing when things are getting too extreme and when you want to lighten up or remove positions here and there. Don't ever be wedded to a particular position or stock just because of the story, right? And when something happens, it happens, and it must get out of your notebook, right? So just knowing when to quit or when to move on, and always find relative opportunities, that to me was always very important. And then the people you surround yourself with, right? You need to understand, especially if you are on a track to become more disciplined, or if you take, the industry very seriously, you want to surround yourself with serious individuals as well. So just knowing, I remember during that time, we had some people in our class who were making wild decisions here and there, very erratic, and they were putting the portfolio down in our notebook, right? So you had to sort of manage that high energy. And the same way now, I surround myself with like-minded thinkers. I know when, I'm talking to someone and they don't resonate with my style, there's a space for that, but it's not going to occupy my total time, which is managing portfolios, right? So I think that is also very interesting. And in general, when you're in careers, you have to find people that resonate with you, and that only lifts you up for the better.
You co-founded the CMT Global Black Caucus. What inspired you in its creation? What role do initiatives like this play in fostering inclusivity and diverse perspectives within technical analysis and the broader industry?
Yes. So, I think meeting Cedric Thompson, who's a fellow CMT, and he sits on the board as well, at one of our CMT events. It was only a few of us that looked the same that was in the same room. So Ralph Akampora also said the same thing, and we wanted to see more diversity and inclusion within the association. So what better way of doing it by seeking globally, right, and starting something of our own? So we did that. We started the Global Black Caucus, and we found that a lot of professionals who were African American weren't just in the U.S., they were all across the world. So that was a big initiative for us. We, actively mentor, we connect folks to different opportunities, and we put on webinar events. So that was great. We had a recent event where we went to Morehouse University and engaged with the students there. I think it really starts with just filling the pipeline from the youth, right? There's a lot of excitement about investing and teaching them that there's many different areas of finance to go into, and the CMT can be one area to really accelerate your knowledge base. So it was very fantastic to put that together. We have a lot of things down the pipeline, and having the board seat allows me to really put that all into action with the backing of the association. So very thankful for that.
As a CMT board member, you wrote that charter holders are champion of high ethical standards, offering objective, well-reasoned insights. How does the CMT framework promote discipline and ethical decision-making in a world often driven by hype?
Yeah, you do get a lot of hype, and we're constantly working on that. As the industry is evolving and you're getting more social media presence, it is our duty to also understand, or help the world understand, how to separate signal from noise and also facts from opinions, right? And some of those opinions might be misguided. There's a lot of predatory behavior that goes on in our industry overall, regardless of the discipline. So I think it's the duty of not only regulators, but also associations to, really put a high standard on analysis, because at the end of the day, there's people's capital at risk. So we are in a very, responsible position. And I think being a board member allows me to make my mark in an industry, because it's an industry that I actively participate in. And I know at some point later on, I'm going to be a sort of beneficiary of that industry, right? Of having my capital managed and all of that. So it's a very important endeavor for me. And, being a part of the association, especially chairing the governance committee, has taught me so much, right? It was a very, high standard as well. It's a very tough committee to be a part of, because we hold the executives accountable by having a nice, well-rounded board and well-functioning board, but as well as being the stewards of our members and making sure that those interests are aligned. So just this week, I was drafting bylaws and knowing about textualism versus all these legal sort of frameworks. But and I'm new to that, but just understanding how frameworks and having a purpose behind what you intend to put in writing is very important. So learning all those things about organizational structure, and not just structure and planning, but execution, is very, very important. You have to get things done. So just merging the two helps me become a better business person at the end of the day. And I think lastly, I think that's an important skill too. We are technicians, we get deep in the weeds. But at the end of the day, it's a passion, right? But you have to put reason behind that passion. And the reason is business mindset. And we all run a business, right? Whether it's a trading book, a portfolio, there is a business behind it. So learning the organizational elements and putting things into execution and sustainable are very, very important skills. And I'm learning all of that by being a board member.
Your work at Babson College and mentoring, you engage with many young investors. What is the single most important piece of advice you give them as they start their journey into these complex global markets?
It is a complex market, yes, and it's getting even more complex. And I say, the same thing that I heard from my teacher when he saw us starting the Stock Market Club. It was find your voice. I still do this. I do a lot in silence, and rightfully so. But there has to be a point in time where you shouldn't be afraid to voice what you're doing, right? And be a good representative of your craft. because you would also inspire others, but you will also connect with other people who are doing very similar things who would not know of you if you were so silent. And I was very silent in school. You know, I was very stuck to my books, and I had my core team behind me, but you know, I had to wait for others to realize what I was doing because I was never able to voice it myself. But over the years, I became a good advocate for myself, and I established my good brand, and I hold those things very, very close to me. And I was able to find great friends and great stewards in the industry. So finding your voice is very important. Being your own thought leader, thinking for yourself, challenging authority. Those are very important skills that build character. And I tell my mentees that, you know, there was one mentee who became the valedictorian, and he reached out to me and was like, I'm also interested in the market, but I don't have anybody to talk to. I was like, oh, really? Like, there's an entire center for that at school. You can, you know, start blogging, start talking to your professors. And immediately after, he became president of certain associations, a student government president, and valedictorian. And you know, he found his voice, and he wasn't able to do that without someone really telling him that he's capable of that power. So if I'm able to tell others that, I should be able to always do it myself, and that's one area of advice.
Dominic, this has been fantastic. Thank you for sharing your journey, your disciplined approach to global markets, and your passion for building community. It's clear why finding your tribe has been so important. For our audience who wants to follow your work and learn more, where are the best places to find you online? Website, social media, etc.
Yeah, LinkedIn is always a good spot for us. You can just search Dante's Outlook. That's where our company page is. Our website is dantesoutlook.com. We, you know, share some of our research there and whatnot. And then we also have a newsletter, Dante's, I think it's dantes.substack.com. If you just go to Substack and search for Dante's Outlook, you should find us there. It's where we publish some of our research that guides our portfolio decision making. So it's very quantitative, very actionable, and the team has been very busy on building that up.
Okay. So, folks, that's all the time we have for today on Traders of the World. A huge thank you again to Dominic Dantes. Your insights are a gift to our entire community. Thank you for your immense contributions to the field and for sharing your time with us today. It has been a true privilege.
Thank you so much, Flavio. I enjoyed my time here, and I hope to see you again soon.
Huge thank you again to my co-host, Alan. Until next time, trade with discipline, stay patient, let price be your guide. Thank you. Bye-bye.
Yeah. Woo. Awesome. Good stuff.
Easy.
Good interview. I liked it. Yeah.
Yeah, we're getting better. We're getting better. Getting
Awesome,
warm.
awesome. Yeah, exactly.
I made an interview 1 day or 2 days before Rafa Campora turned 84 years old, and I made he tell all his stories. He's such a nice guy, and he's a good
He's such a nice
storyteller.
guy. Yeah. Yes.